Hello everyone, this is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool. This is another in my continuing series on YouTube subscriber requests to produce Analyze Out Loud videos on various companies, and one that I've gotten requested probably more than any other for some reason is Newell Brands. So, when people ask me to do this, I can't do as many as everyone's asking me to do. I apologize for that, but I do try to do as many as I can. And so I looked at Newell Brands, and what I saw kind of posed a question: why do people want me to do a video on Newell Brands? So what I've done is I've got a blank graph here on purpose because I want to point some things out. When I looked at this graph, I had a different perspective than when I just looked at it from a statistical perspective. So statistically, the company trades at a blended PE ratio of 8.4. That's very attractive. I'm willing to buy a stock at 15 times earnings. This is selling at a PE almost half that level. The dividend yield is 4.2%. That's obviously very attractive in today's interest rate environment. When I look at the balance sheet, the company has 39% debt to capital, but it does have a BBB minus credit rating, which is not great, but it's at least minimal. It's a minimal credit rating that I would expect in a company. But then I looked at things like operating earnings per share. So let me bring operating earnings per share up on the graph. I'm going to take dividends off for a minute here. And what I saw was a company that was very cyclical, first of all. There are periods where it grows nicely. I'm going back to 2006 here. Actually, I'll go all the way back because I want you to see this. You can see it had a lot of cyclicality from 1999 coming into the recession. It does put together some periods where it grows earnings very nicely. You can see during the Great Recession, earnings fell 38%, but then they recovered pretty nicely. And then we had a string of 7 or 8 years in a row here where earnings grew beautifully. And then in 2016, we had this surge in earnings. But here's an issue that I think is something you all should be aware of, and that is for last year, the company had negative earnings growth, and it's forecast to have negative earnings growth for the next 2 years. So now I'm going to bring monthly closing stock prices into the graph, and we're going to look at it. Now, earnings drive market price. I've said that over and over again on these videos, and you can see that a real clear explanation of it here. You can see how during falling earnings, the stock price fell. Then we did get a nice recovery here, and the stock price rose. Then we had a couple of weak years of earnings, and the stock price was highly valued relative to that. This orange line, by the way, is a PE of 15. So Newell Rubber made 2 or 3 really bad years of price performance, and then earnings recovered, and the price followed it again nicely. And then you see earnings during the Great Recession. Of course, everybody's stock was dropping during the Great Recessions, but in the case of Newell Brands, we had both a falling stock price as well as falling earnings. And then as earnings built up again over those next several years I mentioned previously, we saw a nice run in stock price, from trough to peak, if you will, and I get it pretty close here. You would have averaged over 30% a year annualized on your investment. A $10,000 investment would have grown to $89,500 investment had you been prescient enough to buy it in March of 2009. Of course, everybody was panicked at that point. Very few people were investing, unfortunately. But then now we've had a down year of earnings, and now we have expectations for 2 forward years of negative earnings. So the stock price, once again, we've gone through probably the biggest, even bigger than the recession, drop in the value of the stock. It's fallen almost 60% since June of 2017, so just in a little over a year. And it's currently trading at these low valuations like I talked about. Now, a couple other valuation references we'll look at real quick. Let's go ahead and look at the company from a standpoint of forecasting future earnings growth before I get into that. Now, one thing I want to point out is, before I go forward, is that Newell Rubbermaid, as I call it, or Newell Corporation, has had several good years of analyst forecasts. The company's either met or exceeded analyst estimates. And the reason I bring this up, what this really tells me, what the scorecard tells me, is that the analysts have been able to get this company right from a forecast. So that tells me that these numbers might be correct, that the company might have 2 years of negative earnings. Now, that's a headwind that you need to be aware of because, even though the stock is cheap now, if we have 5 more quarters, which essentially is what we're looking at here or so, of negative earnings reports, we could still see a rather extended period of time, shorter term, 13 months, 15 months, of bad stock price. And I notice it drops down to only 7, and 2 analysts here are expecting a nice recovery for 2020 and fiscal year 2021. So there's a lot of upside, but even if you would look back at the historical norms on this stock, and let me put the normal PE ratio on the graph. This company's traded between 15 and 16 times earnings historically. Now, that's just a reference. I want to make that clear. There are obviously times when the PE got very low. It got down to actually 4.5 times earnings here during the Great Recession. And there are times when the PEs were high, got up into the 20s. So, this idea that a 14 to 16 is a normal range of valuation is true, but it's not perfectly true. There are lots of times when that range works out perfectly, and there are times when, prices get completely disconnected from that range, like we have right now. But using that as kind of a concept, if you will, if this company went back to its normal multiples of 15 to 16 times earnings, then you could have just these tremendous, rates of return over the next 2 or 3 years. The recovery alone could be substantial. And we've seen that in the past. We've seen when the stock got real cheap, in a relatively short period of time, we had significant increase. We had a 170% increase in stock price from the bottom of the recession just into March of 2010. So, when a stock is cheap like this, you do have a lot of natural leverage. You get the opportunity to see the PE ratio expand. But I do want to point out, I'm always cautious when I see a company whose earnings are expected to be down. So I do want to now bring in a couple of other valuation references just to look at real quickly. So I'm going to go ahead and look at the price to sales graph next. And if you look at this company historically, if you run your mouse here as I did, if you were a subscriber to Fast Graphs, one-time sales has been what I'll call a kind of a benchmark average, if you will. There are times when it got up to 2-time sales. It's currently trading at 0.7 times sales. So again, that's not the lowest. During the recession, I got down to 0.4 times sales, 0.2 times sales, 3 times sales actually. So, but this is a low valuation from a price to sales point of view. So the company is definitely cheap on most characteristics. It is a dividend paying stock, and I did mention that, it does pay a high dividend, but let's look at the dividend record. There were years when the company's dividend was relatively flat, from 99 to 2008. It went from 80 cents and then it's hit 84 cents and stayed 84 cents for all these years. And then they cut it during the Great Recession. So the company's, liable to do that. I'll go ahead and stack them on top of earnings here. For the last several years, the dividend has been okay, but the growth rate, actually, let's shorten that to a 10-year graph so you can see what I'm talking about. The dividend growth since 2011 has been about 25% a year. So that's been very attractive. The company has been increasing their dividend quite nicely since coming out of the recession. I add a couple of more years to that, where they cut it rather dramatically. If I add another year here, a couple years, you'll see that they cut it from 84 cents down to 26 cents, then down to 20 cents. And then they've been raising the dividend nicely. But there is a lot of cyclicality in this stock. Now, next I want to take a quick look at free cash flow, because to me, dividend coverage becomes critically important. And this company does have free cash flow in excess of their dividends. I'm going to get price off of this graph here. It's not really looking at valuation here as much as I am dividend coverage. And free cash flow is the cash that's left over after what they need to spend to run their business. So they do have positive free cash flow, but their payout ratio of free cash flow has gotten real high here in the last year or so. But free cash flow is expected to increase again. If I just look at operating cash flows, again, looking for dividend coverage, that's what I'm primarily concerned about here. Operating cash flows have covered the dividend, but they're not expected to cover it in 2019. Now, what I'm bringing up here are questions that I think investors need to be asking. Why are these analysts expecting negative operating cash flow in 2019? What's going on with Newell? Now, to do that, you can go into the company's website, direct from Fast Graphs, like I am right here, and you can go into Investor Services and look for, situations or information, slide presentations, etc. Or if you're a subscriber to Fast Graphs, you can go to these external links and you can go into places like Morningstar or Seeking Alpha, and you can look at articles on the company. And currently, it's up $1.26, and I think that's yesterday's close. But anyway, you can see all these articles. You can also look at things like how the company's done with earnings here recently. Their last earnings report, they did beat. Their revenue was negative, however. And these are just things that you can do directly from Fast Graphs to help you make a better decision. But again, there's a lot of questions about this this company. In my view, more question than answers. I would absolutely agree that based on many valuation references, the company looks extremely cheap. But I would also like to point out that it's more of a recovery situation at this point than it is a solid, consistent, operating history. The company does face some challenges here. The question is, what are they? What do they mean for the future? Why are analysts expecting these down years, and then why do they expect it to go forward? Those are the questions that I think you should be asking. I don't know a lot about this company personally, but the valuation is intriguing enough that it might be one to take a closer look at. This has been Chuck Carnevale saying thanks for watching. If you found Fast Graphs interesting here, you can call us at the number on the screen, or you can log on to www.fastgraphs.com or email us at polyc@fastgraphs.com for more information. Thanks again for watching.